Oh, you want me to rap for you? No, I'm just kidding. So, my name is Brett, 2 T's. You only pronounce the first one, though. Today we're going to talk about collateralized debt obligations, amortization, and other words to impress your friends. Real quick, I'm a mortgage broker. I'm not a lender. I work with a lot of different banks, so I see a lot of different types of loans, a lot of different guidelines. I own 6 doors, and I really do love loans. I love the creativity, the puzzle of everybody's unique situation. I love what I do. We're going to just blast through this 17-step process for synchronizing with global interest rate fluctuation with fractional reserves ratios, based on historical pre-lending metrics. I'm just kidding. I don't know what any of that means. We're going to talk about loans. That's what I do. I know about loans. Generally speaking, I'm going to talk about 4 units or less residential loans. Some of the principles that I talk about apply to commercial lending. They will also maybe carry over to hard money lending. But what I deal with is 4 units or less. That's what I'm going to talk about. I'm going to talk about a couple common investor mistakes. When I get on the phone with you guys, I hear different stories. I start to see repeat mistakes that people do, and so I'm going to try and save you from a potential mistake down the road. And then I'm going to end with what I call the perfect offer. This is the offer when you're getting to the stage of making an offer, whether it's on a primary residence or an investment house or an investment that you're wanting to buy. What is the perfect offer that looks at all the correct terms to get you the best deal? At the end of the day, this presentation is for 2 types of people. If you're not one of these, it's not for you, okay? So I will enjoy your 30 minutes, but it's for the beginner, the person who knows nothing about investing, loans, and credit. This is also for the not beginner, okay? That's the person who knows about investing, loans, and credit, but could learn a little bit more. And so that's where we're at. Here we go, loans. All right, there's a lot of different types of loans. Most people, if they're everyday home buyers, they're only looking at the very top one. Conventional, USDA, VA, FHA. There's a lot of other loans out there. There's a lot of different ways to underwrite a loan, a lot of different ways to calculate income. I'm not going to go through all of them, but I will categorize them. Generally speaking, there is a category. This is going to be all your conventional type lending that revolves around traditional taxable income. So that's, hey, give me your pay stubs, give me your W-2s, give me your tax returns. That is different, or we analyze those to calculate your income and determine whether or not you're eligible to purchase a property. That is different from alternatively documented income. This is maybe more common for self-employed or investors, but we're looking at things like bank statements, maybe multiple 1099s. Maybe we're working with your CPA to get gross receipts. Third class, and this is also common in the investment world, this is asset-based lending. So this is most common in the investor world. It's DSCR, debt service coverage ratio. I'll get into that in just a second. But rather than qualify you as the individual, we're looking at the property, the performance of the property, the performance of the asset, and using that to qualify you for the loan. So, which one's the best for you? Well, it depends on who you are and what you do. If you are Dr. Norris, okay, and you have a great salary of $600,000 because you do a couple surgeries a week, you're probably going to go the traditional taxable income route, right? Your W-2, debt to income ratio looks real good, paycheck comes in every 2 weeks, traditional taxable income. And what that looks like, if you've ever bought a house, we want 2 years of employment history. This is going to be the best rates. Of course, there's exceptions, but generally speaking, this is the cheapest money that is available for real estate. It's buying a primary residence or an investment residence that's based on your ability to produce a consistent income. And it also has the lowest down payment requirements, whether that's for a primary residence or maybe you're buying a four-unit property with 3.5% down using an FHA loan. It's one of the the cheapest ways to actually get your foot into the door in terms of investment real estate. But if you're like me and you're not Dr. Norris, okay, maybe you go by Nail Gun Norris, okay? And if you're Nail Gun Norris, you don't have a salary. You work for yourself. Nail Gun Norris is a home flipper, okay? So he does, I don't know, 2 or 3 projects a year. But each project, he does pretty well. He nets about 75 grand from each project. But there's no salary. There's no pay stubs. Tax returns, especially if you attended the class yesterday, dude's not paying any taxes. You can't go traditional, but you can go alternatively documented income. Practically speaking, in this case, we'd be looking at a bank statement. We'd say, hey, give me your last 3 months or your last 12 months or your last 24 months of bank statements. It can be a personal bank statement, can be a business bank statement, and then based on the nature of the business, if it is a business bank statement, we apply an expense ratio, and that's now your income. So I don't care about pay stubs or W-2s or tax returns. We just look at how much money you make on an annualized basis, and then we qualify you for the loan based on that. It's great for flippers, great for builders, real estate agents, great for cash-only drug dealers, great for small business owners, the pagans of OnlyFans. It's great for independent contractors, wholesalers. There's a lot of people that fit into the niche that could take advantage of a bank statement loan. But if you're not Nail Gun Norris, you're not an entrepreneur, maybe you go by collateralized Chuck. Okay, you have a bad gambling addiction, you really high debt, or maybe you're not quite as sinful, but you do have a large portfolio. You've got a lot of debt attached to your name that's counting against you when you're trying to purchase your next property. We're going to look at asset-based lending. So rather than saying W-2 pay stubs, rather than looking at bank statements, we are going to look at the performance of the asset. Why do we do this? When you buy your first one, the first one's the only debt that's counted against you. But as your portfolio grows, your debt goes up, you maybe are optimizing your tax returns better. Eventually, there will become a point where your income no longer offsets the debt. So underwriting you as an individual or your ability to produce income is no longer sufficient. And so that is when we get into the, rather than we're underwriting you, we focus primarily on the property. We still look at your credit, make sure you pay your bills on time, but generally speaking, we focus on the property in terms of whether or not you're able to get the loan and what loan terms you're able to get. Most commonly in the investment space, this is referred to as the DSCR, or the debt service coverage ratio loan. What that means is we look at the rent of the property, or the anticipated rent, and then we divide that by the mortgage. In the mortgage world, we call it the PISA. In your world, it's typically just called the mortgage. PISA means principal and interest for the loan, taxes, insurance, as well as any association dues or maybe other local requirements that you're required to pay as owning part of the real estate. So if you rent it out for $1,000 a month, but your mortgage is $900 a month, including taxes, insurance, association, if applicable, then you have a positive DSCR ratio. You're going to get more favorable terms with a positive one than a negative one. Typically, these types of loans, 15 to 25% down, varies by the lender, by the program, and you can get them at any ratio. So it doesn't have to cash flow. You can lose money. The interest rate will be slightly higher to offset the risk. But if you're buying a property in North Idaho that barely cash flows under the premise that you're going to look up in 5 or 10 years and it's going to be worth double what you bought it for, might make sense to go DSCR. Now, if you have a problem that I don't, which means you are a genius, okay? You are a genius and you got a lot of cheap loan money in 2020 and 2021. You have a disease that I made up for this presentation called a lot of equity. And when you have a lot of equity at 2%, 3%, 4%, it can be hard to get that equity out because you don't want to refinance it for 6 or 7% mortgage. And so one of the things you might look at is a second lien HELoan. I said HELoan, not HELOC. HELoan, it's a fixed installment loan. The reason we're doing that is because generally speaking, these are allowed on investment properties, which most lenders in the country will not give you a HELOC on an investment property. You can qualify for these using bank statements or DSCR. So even if you are self-employed, there is another avenue to extract equity from a property if you have a 2 or 3% mortgage that you do not want to give up. And generally speaking, you can get up to 80% LTV on these. It can be as low as 65. It does vary lender to lender. And they're going to be 11 to 13%. So it's scenario by scenario basis, but if you've got 300 grand locked up at 3% and you need another 100 at 11%, when you do the math, the blended interest rate is probably less than doing a cash out refi like you normally would. I will take one question.
Do you have a business email too?
I'll give you, he asked if I had a business email. I'll give that to you later. I'll also be on the panel later and walking around if you do have questions. Common investor mistakes. All right, refinance mistakes. Most common refinance mistakes that I see. Number one is not understanding title seasoning. Title seasoning is a fancy word for how long have you owned the property. This is important to understand because every lender in the country who's doing any sort of long-term financing has title seasoning rules that regulate when you can do a cash out refinance on a property. If we are dealing with Fannie Mae or Freddie Mac, conventional lending, traditional taxable income based, it is 12 months before you can have the property reappraised and pull your money out of it. Most non-QM lenders, which would be your bank statement or DSCR lenders, have title seasoning rules of 6 months. So regardless of how good of a deal you got or how much money you put into the property, you cannot do a cash out refinance for at least 6 months. There are exceptions. You can document major improvements, things like that. But generally speaking, it's important to know that before you take on a BRRRR project that you're going to be stuck in it for 6 months before you can get your money out and do it again. Another mistake that I see is not taking advantage of what I call the rate term loophole. I've never heard anybody else in my industry ever talk about this. It's a very unique scenario, but I'd say I'd probably get called on it, this scenario, maybe once every other month. You find a screaming deal, 50% of market value, doesn't need a lot of work. Needs a lipstick, 5, 10 grand, turnaround time's gonna be 1 to 2 weeks. It's such a good deal, you wanna hold it and you wanna refinance out of your hard money, maybe pull a little extra equity and continue on to your next project. Rather than go to your hard money lender and borrow 50% of the value plus rehab, go borrow as much money as they can get you, that they can give you, 70%, 75%, as much money as your hard money lender will give you, because there's no title seasoning on rate and term refinance loans. Meaning, you can refinance this deal in 3 weeks, and because we're refinancing rate and term, the 75% loan that you just got on the property, you've effectively done a cash out refinance 3 weeks after you purchased the property. There's no title seasoning. That's the big thing there, is understanding the difference between title seasoning on a cash out refinance and a cash out on a rate and term refinance. And then the last one is not using bank statements. I would say 85% of the time when I get a call from an investor, they're asking me about a DSCR loan, which is fine. I love doing DSCR loans. They're super easy. But if you have a business that is successful, you're going to save 0.5%, maybe a full percent on your 30-year interest rate if you qualify using a bank statement as opposed to qualifying on a DSCR loan. So, I mean, it's your mortgage lender's responsibility to educate you on that. But just remember that bank statement loans exist, and they are cheaper than DSCR loans as a whole. Credit mistakes. Number one, anytime you're getting a loan and your credit is less than 760, it's costing you money. Sometimes it's not a lot, but if you're like, hey, how good do I need to get my credit? What's the magic number? The magic number is 760. Okay, every lender in the country has an LLPA, which is a loan level price adjustment, and they look relatively like this with different pricing. On the left-hand side, you'll see is the credit score. Loans are priced in 20-point credit blocks, meaning a 619 can be 1 point more expensive than a 620. That's important to know. Also, loan LTV, this is probably more practical as an investor. If you're refinancing a property, you should be refinancing to the nearest 5%, because If it's a 61% LTV, you might as well go for 65. The money, the loan is going to be the exact same. Similarly, if you're refinancing at a 66% LTV, maybe bring a little money to the deal because if you can get it down to 65%, you might save 1 point in interest or a half a point in your rate, which is going to save you a lot more money over the life of the loan. It's important to understand 20-point credit blocks, 5% LTV blocks as an investor. This one's always fun. It's a lot more common with newer investors, but not putting credit cards in LLCs. Okay, let me give you a fictitious scenario. Chucky's been on Bigger Pockets. He heard that he's supposed to buy a wholesale deal using other people's money. He decides, the hard money lender is going to force him to come up with the renovation cost out of his pocket, so he funds the flip on his personal credit cards. That happens, and so because he maximizes his credit card usage, Chucky's credit score went from a 739 to a 619, and he's never going to be able to get a loan with a 619 credit score using DSCR, bank statement, or traditional taxable income. Okay, he's destroyed his credit, and so now his only option is to sell. That may be the option from the outset. Maybe it was just a short-term flip, but it would be better if Chucky, went and bought a wholesale deal using other people's money and funded the flip on his LLC's credit card, because LLCs do not report to personal credit, and now Chucky is not forced to sell it. He obviously still can, but credit utilization on your LLC's credit card does not impact your personal credit score, which is, it's important to know. How do you get a LLC credit card? Well, you set aside 1 hour. You form an LLC operating agreement. You can do this on ChatGPT. That's not legal advice. You can register your LLC with the state. Takes about 5 minutes here in Idaho. You get an EIN number with the IRS. You apply to Chase or Bank of America. Those are the two that I know don't report to personal credit. And then you relax with the extra 30 minutes because it didn't actually take an hour. Okay, it only takes 30 minutes to do this, and it can save you a lot of headache down the road. Last thing, and this is kind of the kiss of death in the real estate world, never, 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 if you can all avoid it, make a late payment on a mortgage. Whether it's the home you own or it's a property with a hard money lender, we're always going to verify mortgage payment history. And if you have a late payment in the last 12 or 24 months, it's going to be really tough to get a new loan. All right, the perfect offer, okay? When I say the perfect offer, this is the offer that I try to make whenever I'm buying a property. This is also the offer that I advise my clients to make anytime we're entering that offer-making negotiation stage of the residential purchase process. Price doesn't matter. Price doesn't matter. Terms matter. Okay? Price is a term, but it's not the only term that matters. Let me give you an example that I made up. If I sell you a property at triple the value, but I'm seller financing it to you at 0%, and you don't ever have to pay me back unless you sell it, that's a grand slam. The price is irrelevant because you would never sell it. You're going to rent it out and live off the cash flow. Now that's a fake example, but it illustrates the point that in that scenario, the price didn't matter. Let me give you a more realistic example. If you're assuming a 3% mortgage note, or you get seller financing at 0%, the deal is more valuable because the terms are better. You can afford to pay a higher top line price because the terms of the deal are better. When I say terms, I'm of course talking about price. I'm also talking about the interest rate. I'm talking about seller concessions, which are super crucial. I'm also talking about the closing timeline, which may or may not be relevant. These are all terms. There are other terms that go into the deal, but these are all terms that you as an investor should be paying attention to. Seller concessions. This is probably the most, in my experience, the most underutilized negotiation tool. It's becoming more and more common, but always negotiate seller concessions before lowering the purchase price. Always, 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 always. Seller concessions can help you pay closing costs, which are costs that you have to pay today. They can also be applied to lower the interest rate of the loan. The speaker right before me talked about how builders were paying $20,000, $30,000, $40,000 towards the interest rate in order to keep their prices high but make the house more affordable. That's a seller concession. They're making a concession, they're giving you some sort of money to entice you to purchase the deal, and you can do this on every transaction. Every type of loan has different seller concessions limits, but when you have the seller pay your closing costs, pay your title and escrow fees, your loan fees, your prepaid property taxes, your prepaid homeowner's insurance, that's saving you money today rather than lowering the price and saving you the same amount of money but amortized over the next 30 years. Puts more money in your pocket for the next deal. That's all I got.
And you still have a few minutes.
See,
Any questions?
you thought I was going to run long because you saw 105 slides and you're like, holy cow.
I saw 108 slides.
Oh, okay.
Okay. Here we go. Question number 1.
To set yourself up for a DSCR loan, if there's 2 LLCs on the property, do both of those need to go on the DSCR loan, or how would you set that up before we come to you and say we're ready? Because there's a few more months before the 12-month.
Why are there 2 LLCs on it currently?
Because we did not open an LLC together, and there's 2 partners, and so this is our first time doing this together, and we thought we were gonna flip it, so we just did it to protect ourselves with both of our LLCs.
So there's a couple answers. Number one is you can close it in 2 LLCs again. The only caveat there is you're going to get the best rate, the best loan, if there is somebody who's personally obligated to the mortgage, which is typically one person in an LLC. Whoever fills out the loan application, because rather than a non-recourse LLC, which do exist, meaning if you don't perform as the LLC, we don't come after you as the individual to pay it. Those loans do exist, but they cost more. And so what I would recommend, is the plan long-term to keep it together?
I think it is now, yeah.
You can close it in 2 LLCs and get a non-recourse loan.
We have built enough rapport with each other that, like, if you say it's better to put it in the partner's name or mine, like, however that is to structure it for when we get to that date, that's fine. I think we've built enough rapport and business trust with each other now to do that, and then add somebody to the deed afterwards.
The answer to your question is you can do it either way. If I were in your shoes, I would have 1 LLC with 1 person who's the primary partner, who's personally obligated for the performance of the loan that you're putting on the property.
Okay, and then add the person, or
Yeah,
open a new LLC or something.
Correct, yeah,
with-
both partners.
I gotcha.
Yeah.
Okay.
Just one more small recommendation. I don't know if it's the best one, but you could have a new LLC that both your LLCs are just members of that LLC. And then that one LLC goes to get the loan. Sorry.
Yeah.
Next question.
I got a question on your debt to service loans. So I've commonly heard, and this is probably a misnomer on my part, but like 1.25 times for your debt to service coverage, especially on the commercial side of things. You said, but you can get them at all sorts of different rates, especially in like non-cash flow markets. Can you elaborate on that? Like, how do you get like a break-even property where it's not cash flowing, but still have that loan approved at 0 cash flow?
So commercial's a different beast. Typically, you're going to need, the lowest I've ever seen commercial-wise is 1.18 DSCR that they're going to want you to perform at. I'm sure, I don't know every community bank in the country who offers these. I'm sure there's exceptions and different things like that. But commercial-wise, the DSCR has to be at a higher performance rate. In terms of residential, it's really 1.0 or greater is one price block, and then less than 1.0 is going to be more expensive. Less than 0.75, meaning your rent's $750 and your mortgage is 1,200, let's say, that's going to be even more expensive, but all of these are still lendable. So it's really 0 to 0.75 is the most expensive. 0.75 to 1 is cheaper, but anything over 1 is going to be the cheapest.
Next question.
Hi. So you were talking